Hey everyone, welcome to the weekly review. Doing this early because I'm going on vacation tomorrow and I'll be away for the next 3 weeks. I'll still post on Blue Sky, but no more videos until I'm back, and we're gonna post a lot less often. But for now, let's look at what happened. Yesterday, inflation, huge overprint, almost double the expected nowcasting level, which was like 0.25 26, and it came out 0.46 ish, not exactly that, but rounded up to 0.5. So yeah, huge print, but surprisingly the market bounced due to those there were two trades here. First was SPY, this 3.3 billion, but there were a couple more, almost 4 billion, yeah, in total. And the other one was IGV, tech sector ETF. Biggest name is Oracle, which saw like what's this, 430 million. So these were the two buys that turned the market. Uh, we had at the close what appears to be a deep buy on TLT, almost a top 100 print with almost 700 million. We have 1.5 billion for IVV at the close as well, which again, I think this is distribution, so I I think this is a sell. Also noted FXY, which is seeing some profit taking, I'm assuming here. And I don't really like the Chinese names anymore. Like I think they went too far. Like Baba almost hit 120. It's at AV up here. Maybe earnings when it finally comes because it gets pushed around in TradingView, gets it to break out. But from a technical perspective, I think it gets rejected here. We shall see. Um, and we have PPI and retail sales, PPI today and CPI retail sales tomorrow. I think there's potential for a delayed bearish response. We shall see today. But an example of that would be like this. This was a FOMC meeting. JPA was bearish, but the market for some reason went up 3%. And the next day we had a minus 3.55 and beginning of a new leg down. And there's potential for something like this to happen. If it doesn't happen, I think we are in a window of unrealized weakness until OPEX, and then there's potential for a breakdown because things look similarly to what they did in February 2020 before the COVID crash. Like VIX tends to do uh, tends to start moving higher before we get a blow up, and at the same time the market goes up. Like if come on, click. If I add SPY, and let's invert. Oops, not this one. Let's invert SPY. So while VIX is going up, SPY is going up as well until it doesn't. And this is a common pattern, uh, like here as well. Before big blowups, VIX starts going up, and this is the COVID crash, and we see VIX making higher low and SPY making higher high. At the top in 2021, same thing. Like VIX was starting to make higher lows, and we are in a similar situation here as well. And the buildup in energy is quite substantial. Same here. Before this blow up, like VIX was starting to go higher, and while the SPY was making highs. And I think we have crossed the point of no return on this one. So be very careful post OPEX. And I think we have quite a build up here. Like we should see a huge move in VIX. Now, what is still constructive is the fact that yields are kind of controlled. So before this, let's look at the Brett indicators. You can see everything went down. Even yesterday, when the market basically recovered, everything was going down as well. It looks really similar to what it looked like before we had that 3% day, minus 3% day in ignore slowing breath. Positioning breath also looks like shit. We print yesterday. There's divergence here. The same thing happened in COVID crash. So lots of red signals, even though the fact that the market is the dip is being bought is good as well. VIX has a floor at 15. Anything below 15 is a good buying opportunity, and volatility is probably cheap. Yeah, back to yields. The encouraging thing is that there's no follow through right now, or as of now, on yesterday's move. The 2-year went to the FFR level, which is 4.375, and stopped there. And I would like to see it stop there. If the 2-year goes higher, that's a bad sign. But there is actually no reason for it to go higher, in my opinion, because let's say even if inflation is 3%, if we go to 3%, 0.37 premium over inflation, even if it were to go to 3.5, we are still above the inflation level, and uh, things are restrictive. So, and the 10-year, which is the benchmark, is even higher than that. Like we are 1.6% above the inflation rate. So things are restrictive from that perspective. As long as yields basically calm down and stay at this level, and let's say the 10 years stabilizes around 4.5, and 20-year comes down a bit lower as well, like here, then things are fine, because what if bonds stop moving higher, what it tells me is that the bond market is considering both a potential slowdown in growth. The fear of tariffs remains there, but the inflation fear has already been priced in. Like, what the fuck was this? This is the inflation fear being priced in. We went from September at 4% on the 20-year to 4.89. We hit 5% just recently. So this is the fear of inflation being priced in. Now it just has to stay here, and it will probably stay here. But there's actually no reason for it to go higher. If it goes higher, it's forcing the it's forcing a break of something. And if we actually get that correction post OPEX or starting now, then I would expect yields to fall a bit lower, like maybe the the 20-year goes to 4.5 or 4.37, something like this, something around here, because if equity is correct, there will be even a bigger fear of growth. If we do get that, this should happen. So yields, the pop here should be short-lived. Uh, then we have on the other side the potential for peace in Ukraine, even though basically it's throwing the US is throwing Ukraine to the wolves, or in this case to Russia. If an agreement is reached, oil should go down. We should see a breakdown in oil. And I get that there's fear of tariffs and the egg thing in the US, which is temporary, but I still think there's a bigger risk of growth slowing than inflation coming back and sticking around. This inflation scare is temporary, it's more psychological and short term psychological, but longer term, if all things fall together, then we're looking at more potential for deflation. And the only reason why it's not happening yet is most likely corporate greed in the US. But imagine PPI comes in not as hot today. Then what's the play? Like what will the market do? Because the moving yields should calm down a bit. Equities maybe go a bit higher, but again, there's not a lot of room to go higher. And once the OPEC cycle unclenches positioning, then we have potential for a big flush in equities as well. So that's kind of how I see things here. Basically, energy is deflationary if we get peace in Ukraine. Yields are at the appropriate level and taking account border risks and of slowing growth and inflation. But the system is quite fragile, meaning if something overshoots, like let's say yields go to Rita's this size here for no apparent reason. Like this would force the breaking of the market. And the forcing the breaking of the market will cause this because they broke it, now they have to fix it. So things are quite fragile where we are right now. Uh, be careful post OPEX. Like I said, there's a risk uh, of the market re- reversing yesterday's move today, and uh, that's kind of it. Okay, have a good one. See you on Blue Sky. Bye bye.